Okay, guys, so Cardano fell by 11.71% yesterday and into the early hours of this morning. This is kind of mainly down to a little bit of knee-jerk reaction in the market after Donald Trump's tariffs on the EU. We were looking pretty good to the upside. We hit our first set of targets around 84 to 85 cents. And then we see this 11.71% move to the downside. So let's go ahead and give ourselves a bit of an update onto the technical analysis here for Cardano 𝗓𝗓. So as you can see, pretty interesting slippage to the downside. Now we were initially tracking a 5-wave move to the upside. We hit the kind of 1.618 targets. These were around the kind of 80-cent level, and you can see the consolidation just here before we pushed on up into those final targets. Problem that I have is the internal structures don't really make a terrible huge amount of sense when we start thinking about this move as a 5-wave impulsive movement. Now we have the context of this move to the downside. Okay, so let's kind of now readjust our kind of position here, because we now have to look at this through the idea of a corrective pattern. So what we've actually got going on is a W, X, and Y pattern, and it consists now of an A, B, and C here, and then an additional A, B, and C here. Okay, so whereas we were looking at this as an impulsive movement where we'd have 5 kind of waves, you'd have 3 impulsive ones at 5-wave structures, they'd nest inside and you'd have a bigger impulsive run or bigger kind of trend-based run. With that news, that fundamental news kind of shaking the market, it's now changed from that kind of more confident trend-based move into now just a short-term corrective one. It's not the end of the world, because that's kind of the story of Cardano in 2025. We have a lot of these kind of corrective waves that could have become strong trends only to reverse on us. And so it's very much the same kind of story. Now, as we look at this move to the downside, a lot of people will begin thinking, okay, are we doing now a new downward trend? And well, it looks on the surface like that is the case. However, again, we've exceeded what we would typically expect of a final 5th wave movement. So it met the initial stages of this. So you'd have your wave 1, your wave 2, your wave 3, your wave 4, your wave 5 would have completed somewhere around here, but it went down a little bit deeper. Possible, yes, it can continue to do that. However, I'm looking at this again through that corrective idea that maybe we have a slight overextensions within the C waves, and what we've actually got going on is going to be more of a W, X, and Y. The next kind of few hours is going to be quite important. So as I look at this market, I think to myself, okay, well, we've lost the 200 EMA. That is our white line here that was acting as support. We lost the 50 EMA and the 50 SMA. And so we want to be thinking that this is actually a prime area for short positions rather than long positions. And so we might actually be thinking about going short on the market. I'm looking for a 1.5 risk reward ratio, but we might just put a trailing stop in, something to that effect. Resistance on that 200 EMA, in my opinion, is likely to hold. Okay, so as we think about this, we want to think about the continued break to the downside. Now, where do I think, if I'm right about a WXY, where do I think that is likely to be going? Well, I think we are going to be looking for 72 to 71 cents. Okay, that's going to put us a little bit deeper than where we were kind of initially hoping, but it is right inside this kind of previous area of support and resistance. So we're not terribly too concerned about it. It to me looks like it's a reasonable area. We could in fact extend our take profit to this area of around 72 cents, gives us a 1.99 risk reward ratio. And I think that's ultimately probably the smarter play here when it comes to Cardano. Okay, so that's what we're going to be looking for. We're going to be looking at this as an A, B off the rejection from the 200 EMA, down to 72 cents for the C wave. That all then gets wrapped up inside a larger W, X, and Y pattern like this. Now, if I zoom out of this far enough, this actually, there is one kind of really big bearish situation to still kind of consider here, which is that we are actually still inside a bigger corrective pattern. I'll use WXY for this as well. W down, Y wave up, and an X wave up and a Y wave coming down deeper, probably losing 70 cents altogether and looking to lose the existing low down here, coming in at 71 cents. Okay, and so you can see that this might be a brief support range, but we need to bounce and then lose it at a later stage. Okay, so I use WXY over here. Again, we can think of this as a string of corrections. But if we were to bounce back up, find a resistance, and then have another W, X, and Y to complete out this bigger macro pattern, we kind of get the idea. Okay, so I'm going to be really kind of cautious on Cardano over the next couple of days or so, because there are a few bearish things that potentially are unfolding. Now, is it all doom and gloom? I don't think so. Okay, so let's go ahead and just tidy off all of these lines. We'll leave those on, right? Take a look at the stochastic RSI here on the 1 hour time frame. That's the time frame that we're on right here. And you can see that we're up in this overbought area. So overbought basically means that the market's overheated as it's had a little relief rally. As it comes up to that 200 exponential moving average for resistance, the expectation should be that actually price action is more than likely going to get rejected from the previous support. So support turns to resistance from the 200 exponential moving average, and in line with Elliott wave psychological analysis, basically telling us that people are just going to be looking for a reason to kind of offload some positions. And so when we think about that, yeah, our target's going to be 71 to 72 cents, right? And that is going to be the kind of area where we think there's likely to be a support, because obviously you have previous support found down here, but also it comes in line with the Fibonacci levels, which basically are psychological levels that people are kind of using. So the stochastic RSI is aligned to that idea. The relative strength index is also in bearish territory here. Okay, so we're lower than 50, which basically means it's bearish momentum, it's a bearish oscillator. Now, it doesn't actually mean that the price action has to go down, right? It just shows that there's strength in this movement. It basically tells us that the momentum behind the price action, buyers and sellers, is more bearish than bullish right now. That's essentially what the RSI is doing. It's one step removed from the price action. The stochastic variation, the one that I showed you just a second ago, is 2 steps removed. So it's really loosely tied to the price action. It just shows you whether there is momentum backing the price movements. And here you can see that actually the stochastic RSI is showing us that actually things are overheating, indicating that actually there's going to be a shift now from that relief rally into a bearish sentiment. No guarantee, of course, but that's kind of what the momentum is indicating. And then we have the relative strength index, which is less sensitive to the price movements, in bearish territory, also indicating that the longer term play here is still a bearish move, considering everything that's going on. So both of those are telling us that actually this market is more than likely going to see a bit of a move to the downside. Then we have the MACD histogram. I don't like the MACD lines because they're just glorified moving averages, and we already have those on the chart. But this histogram is a visual representation of the momentum behind the price action. Sometimes it's easier to see it this way than it is to see it via things like the relative strength index or the stochastic RSI. Now, in this case, what do we see? Well, we can see that there was weakness within our green histogram bars. Basically, as buyers were coming in, they were getting weaker and weaker and weaker. And of course, we had some news that basically just was the excuse to pull the trigger on your sell orders and to see that price come down. It showed that there was a real lack of interest in buying. But at the same time as that, there was also a weakness within the selling side. So really, there was no real reason to be selling. There was no real reason to be buying. The price was stalling out, and we're just looking for an excuse one way or the other. So if there was some positive news, we probably would have rallied, and with the negative news, we could see that there was just an excuse to kind of sell. So that's kind of what we saw. And then from there, what do we see? Well, we now see strength in the selling overall. Okay, so now we can see long-term view here has shifted. Our long-term view has shifted to a point where, yeah, there's weakness within the buying side and there is strength within the selling side. Okay, so now we have to kind of keep this in mind that we could potentially be looking at testing 70 cents and potentially even lower. Okay, so now obviously sentiment has shifted, and that's kind of what the MACD there is indicating to us. So we want to be aware. At the point of recording, we're about 75 cents, right? So we could be looking at losing 5 to 10 cents off the price action over the next little while. Okay, so obviously stay tuned to the channel because we will, of course, be diving into this. Every other day is when I do technical analysis, and every other day I'm doing news-based videos. So you'll get a little bit of the fundamental news, and then you'll get a little bit of the technical analysis. So stay tuned to the channel for a bit more on that. Now, if we come and bring this up into our daily time frame, the daily time frame kind of gets rid of a lot of the noise. And am I concerned over everything that is going on when I take a look at it from a daily perspective, considering the analysis here is going to span, weeks, right, and months. And for the most part, actually, it's not a bad place to be. If we take a look at the daily chart here, we're actually above the 200 exponential moving average, which is, for most traders, the trend filter, right? When you're above the 200 EMA, you're bullish. And when you're lower than the 200 EMA, you're bearish, right? Simplistic. And so we are above the 200 EMA and we're above the 50 EMA and we're above the 50 SMA, okay? And as I spoke about before, there is a golden cross probably 1 to 2 weeks out, okay? And the golden cross is the 50 simple moving average crossing higher than the 200 moving average. Personally, I don't really buy into all of that nonsense because all it's really doing is showing you what's already happened, right? But traders and retail traders specifically will, of course, react to the news and the golden pockets and the golden cross kind of headlines. What you tend to find is that positive kind of sentiment comes back into the market. Now, what that means is the 50 simple moving average crosses higher than a 200 moving average. Simple terms, the short-term price action is higher than a long-term price action, right? So we can see that that's about 1 to 2 weeks out, as long as we don't have some kind of catastrophic drop in the market. So for Cardano on the daily time frame here, it's actually in a pretty good spot, right? The 200 daily EMA is coming in at around that 72 cents, 72.05 at the point of recording. And support is currently being found there. This was previous resistance, as you can kind of see over here on the chart. So previous resistance, we broke through it, we tested it as support, we rallied, we're coming back down. Are we likely to find the 50 EMA, the 50 SMA, or even the 200 EMA as continued support? More than likely. A move down lower than kind of 69 cents on the daily time frame, and to sustain it is going to be a bit of a challenge because the bulls are currently in control on this time frame. So on the smaller time frame, there's a little bit of worry, right? And so we might find that there's a few crazy wicks that take us down to 71 cents, maybe 70 cents, maybe even dropping down towards 69 cents, right? But I don't think we're going to see any daily closes lower than that 200 EMA because I think it's going to be heavily defended by the bulls. Could be wrong, but that's kind of what the analysis here is kind of hinting at the point of recording. So as we kind of think about this, our positions here on the candlesticks, they aren't terrible. We have higher highs, we have higher lows. Now, from our histogram, we can see that there was a bit of pressure here from the selling side, but the most recent sell-off hasn't really created a lower low from the histogram bars. So it shows that actually selling pressure from yesterday is actually weaker than what selling pressure was over on the 20th of May. So actually this isn't terrible, it's not awful, and we might actually start seeing a few interesting movements. Now, as I was indicating before, there is that slight divergence there. It wasn't anything major, but we did see a little bit of bearish divergence. Basically, we had a higher high on price action with a histogram bars here indicating a slightly lower high. That is bearish divergence. Price went higher, but the movement and the price momentum behind it was weaker. So it was bearish divergence, right? Now, with that, we saw this break to the downside. But like I say, right, on the smaller time frames, it was kind of an indecisive market. Positive news, we would have rallied. Negative news, we would have seen what we did, right? So I'm not terribly too kind of focused on these indicators. Now, stochastic RSI is in a pretty interesting spot. It's got a bearish cross indicating that there's still the potential for more moves to the downside, but it's also oversold, indicating that actually sellers are exhausted and buyers might actually step back in. So if we do see buyers stepping in, we are going to be starting to see a bit more of a run to the upside. So it's not the worst case scenario. Can we be down here for a lot longer in the oversold area? Absolutely, because the stochastic RSI does not relate to price. It only shows you the strength of the movement. And it tells me that actually sellers are more than likely starting to get exhausted and buyers might actually start stepping in. Couple that with the 200 exponential moving average as support, and the Elliott wave indicating around the 71 to 72 cents, which also falls in line with the 200 exponential moving average of the daily time frame, and you kind of get confluence to say that actually support is more than likely going to get found. But of course, we are talking here on the video about probabilities, and at the moment, there's more probability that we bounce from the 200 EMA than there is from a complete collapse. But we do have to hold in mind the fundamental side. If, of course, something else happens geopolitical wise, maybe another tariff somewhere else, that could, of course, cause more panic selling. And so therefore, we would potentially lose the 200 EMA. So we want to keep those things in mind. But from a pure technical analysis standpoint, there's a higher probability that support is going to be found here and a relief rally or even a more sustained rally is going to be found. The relative strength index on the daily time frame is also above 50. Like I said earlier, anything on the RSI above 50 is bullish territory. Even with the wobble that we had yesterday, we haven't lost the bullish area of the momentum oscillator. So our upward movements and momentum is actually still intact. So again, we aren't going to get terribly too concerned over this most recent wobble until, of course, these indicators start actually showing us weakness. Specifically losing the 200 EMA, losing the 50 level on the RSI, and staying consistently oversold or even rapidly moving from oversold to overbought on the stochastic RSI variation. And then of course watching those MACD histogram bars to see whether or not selling momentum increases and actually pushes us into that bearish territory. Lots is still up for grabs here, but I do think that for the most part, we are still finding ourselves in the bullish end of the territory and not the bearish one. Now, in the previous update video that I put out, I was looking for the $95 to $1 range. That is still very much a valid area, but of course, I am concerned over the overlapping nature of the candlesticks. Okay, so basically, when we have Elliott wave is basically just psychology. It tracks the buyers and the sellers and their behaviors behind their price movements. It's a complicated subject. It's not for everyone. I understand it and I like it because it resonates with how I trade. One of the things with Elliott wave that it tells us is when you have overlapping candlesticks, like what you see here, it tends to mean that we're in a short-term move, not a long-term trend move. So although the price action has gone up into higher highs and higher lows, it's not sustainably going to be that way. And what I mean is that at some point, this structure is going to reverse on us, right? And unlike a trend-based move, which can have significantly higher impact, like this one over here, where we had this significant surge to the upside, though there was no overlapping nature to the candlesticks until we got into this upper area, which was of course our distribution before we went down into our accumulation. This one is very different, right? So it's got the overlapping candlesticks and it has got an upper limit to how high it's going to go. That is going to be between 93.87 and $102.54. No guarantees, of course, but that is what I'm targeting on this internal area for the next kind of major distribution and major correction in the market. Now, could we fall short? Absolutely. But this is kind of what Elliott wave is predicting us at the moment. It's based on a corrective pattern. We are looking for something to this effect, right? You have your A up, your B down, and your C up like this. This is going to get wrapped up inside of your WXY, your W, X, and Y. And so this is the area of confluence for a rejection. Our daily stochastic RSI and RSI and MACD histograms could all be pointing towards this area as well on the daily time frame. But we are on the daily time frame, and that does not mean this is going to happen today. It does not mean it's going to happen tomorrow. It might not even happen by next week or the week after that. It can take some time to play on out, but that is what we're looking for. Now, any breakdown of the previous swing low, okay, is going to invalidate that idea. Okay, so anything lower than 64.26 cents breaks this idea, and it means that it's not likely to happen. So if I were to swing trade this one, I would be looking for long positions. Okay, I think there's going to be better entries than right now, but for this example, I'm going to use the right now as the example entry. We're going to put the stop loss just lower than that previous swing low at around 64 cents, and we're going to target out 1.5 on the risk reward ratio. Okay, that is going to target that lower end of our target range at around 94 cents. So as you can see, you can trade this one. It's going to take some time. You'll have the position open for a while. This is not going to be for everyone. It's going to be for those people who can actually stomach volatility. If you can't stomach volatility and you can't keep your emotions out of the game, this one isn't going to be for you. But if you can, this actually looks like a reasonable setup on the daily time frame, something that could last 1 to 2 weeks or maybe even 2 to 4 weeks. I can't time the market. I'm not going to tell you how long this stuff's going to last. It simply is what the Elliott wave and the psychological element of the trading is telling me. That doesn't time the market, right? It's going to take whatever length of time it's going to take, either to completely break down or hit its target, right? And of course, I do think there's going to be better entries, which gives us better risk reward ratios and all that kind of stuff. Use proper risk management. Don't use more than 1% of your trading account. Don't go ahead and do something stupid like 100x leverage, 20x leverage. You do something really small, 2, 3, 4, 5x leverage max. And, obviously not financial advice, just how I would approach the market. And if you are going to be looking to trade, check out the Discord. linked in the description down below. Sign up to something like Bluefin, BitGet, etc., and join the profit pit, because in there we are actively trading, and you'll see all the entries, exits, stop losses, everything you need to know about our trades and what we actually are doing actively in the market down in the Discord server. All the links are in the description down below, so you can go ahead and check it out if you want to. But again, not for the faint-hearted. So as we kind of see here, this is kind of what I'm looking for on the daily time frame. And all of this is a part of a much bigger play over multiple years. We are targeting out significant highs, new all-time highs coming in on the low side between $3.09 and $4.77. On the kind of more I guess, optimistic side, we're looking for $5.27 to $12.91. Very difficult to get that higher end in my opinion, but you can see all the Fibonacci levels and how they relate. And then of course you've got those kind of moon boys who just going to shout for like $38 or whatever. Now, time-wise on this kind of stuff, you're talking, earliest is going to be Q4 2025, and it could go on for as late as 2029, 2030, right? I can't time the market. What I can tell you though is that the market is going to be testing your patience, and it's going to be testing you emotionally, because as I'm plotting this out, it is looking a lot like corrective patterns stacked inside of a much bigger 5-wave pattern, which is a part of a much bigger corrective pattern spanning the last 5 years. And so we're going to get there. It's just going to take time, in my opinion. Of course, that's going to wrap up today's video. If you have found it useful and informative, smash the like button, subscribe if you're new, and I'll catch you in the next one.